Hi friends, Simon here from informedtrades.com. In this video, I want to take a look at the case for $20,000 an ounce gold. As always, this is just a viewpoint being presented. How credible this viewpoint is or is not is something that you should decide. But I think it's something worth discussing for those interested in the gold market and sort of where it may be headed. Okay, the key points in this video: the supply of debt in the G20 economies cannot be repaid. It's simply greater than the supply of money. At the same time, central bank reserves of US dollars are declining, which suggests that the world is moving away from even the idea or capability of paying off the debt with US dollars. Meanwhile, central bank gold reserves are increasing. So why are central banks increasing their gold reserves? Are they going to use it to pay off the debt? That's something that is a potential viewpoint, part of this whole discussion of gold's future price. If we divide the external debt by the supply of gold, we get the price at which gold can be used to pay off debt. That's where the $20,000 number comes in, as we'll see. The wild card to this whole discussion is a new international monetary agreement, and also ECB is already marking the value of their gold to market price, which also suggests they may be interested in using gold to balance their liabilities. Okay, key points. First is that G20 debts are simply too big to be repaid. We've already passed. Here's the G20 in 2010. We've passed the 100% mark. Basically, you could raise tax to 100% in the G20 economies, use all of that money to pay off the debt, and you still wouldn't have it paid off. So clearly there's an insolvency issue that's going to need to be reconciled in some way. Central banks are decreasing their holdings of dollars, so they're moving away from dollars towards something else. This is something to consider when you ask, how is the debt situation going to be resolved? It doesn't even look like they're moving away from dollars, so it suggests the dollar may be less of a factor in paying off this debt. Meanwhile, central bank reserves of gold have been increasing since the 2008 crisis and continue to increase. That suggests, are they looking to pay off their debts in gold, or is that going to be part of the solution? Okay, now if that is part of the solution, we can do some math to determine at what price gold can pay off the debts. So here, first thing to consider is external debt. External debt is debt held outside of the country or by foreign economies. Domestically, countries and economies can have a little more at their disposal. They can, it's easier for them to print money. They can cancel that. They can rewrite the rules. Externally, they're a little more subject to external bondholders that can wreak havoc by dumping the currency. So external debt tends to be a bigger factor. U.S. external debt is currently $5.557 trillion. The U.S. has 287 million ounces of gold that the Federal Reserve holds. If we value that gold at $16.50 around its current market price, we see $0.47355 trillion is the value of that gold. So there's clearly the supply of debt is much greater than the supply of gold at the current market price, if we value it at the current market price. Now, if gold goes to 19,362, that's currently the number at which the U.S. gold supply can be used to pay off U.S. liabilities. So that's sort of where the math comes in and where we get that $20,000 number. That's the number at which the U.S. supply gets a bit balanced. Okay, now to support this viewpoint, or to, something that proponents of this viewpoint think is happening, or why they believe in it, is that the ECB is already marking their gold to the market price. So on a quarterly basis, the ECB, here's the volume of their gold, but the value of it that they have on their balance sheet is rising because they keep revaluing it based on its current market price. So why are they revaluing it? They're the only central bank doing this at the moment. It suggests the possibility that they're looking to balance their liabilities with gold. That sort of supports this whole viewpoint. I also think that's why the euro has been rallying significantly since the start of this year. Okay, the whole wild card to this discussion is whether there's going to be a new monetary agreement. That seems essential since there's an insolvency issue. As part of the new monetary agreement, is some of the debt going to be canceled? That would throw off the equations and the math that we looked at earlier in this video. At the same time, how much more debt is going to be added before a new monetary agreement comes? This is a big question. It's a big wild card for those who believe that gold is going to be used to revalue or balance the debt in some way. That's about it. Any questions, anything you want to add, join us at informedtrades.com. Thanks and best of luck in your trading.